Next thing that we're going to talk about is interest rates. So it's something that's on every single person's mind right now. A lot of fluctuations, very unstable over the last year or two. And interest rates have been a major factor in real estate, over the past few years. They always are, but over the last few years, it's even more so been because you've seen so much turbulence in the market. Welcome back to Keeping It Real Estate, the podcast that brings you the latest trends, strategies, and insights in multifamily investing. I'm your host, Mike Roeder, and today we're going to unpack our 2025 multifamily market outlook. We're going to be diving deep into 5 key areas shaping the multifamily market. So number 1, vacancy. Number 2, rent growth, supply and demand, interest rates, and cap rates. And whether you're an experienced investor or just getting started, this episode is going to give you some actionable insights to navigate the market that we're in here in the beginning of 2025. But first, I've got something for you, our free ebook, The 4 Steps to Successful Passive Investing. It's a must read for anyone that's looking to potentially passive invest. Download it now at www.granitetowersequitygroup.com, and you can click on the tab that says ebook. So let's go ahead and get started. So let's talk about vacancy rates first. Vacancy rates are one of the clearest indicators of market health. And here's what we're seeing in 2025. So as of late 2024, the national vacancy rate was 8%, holding steady for the first time in years after a period of oversupply. So there's been a lot of supply over the last year and a half, 2 years. Still expect a decent amount of supply to hit the market this year. And then it really drops off the market. And we're going to talk about that more in just a bit. But this is really significant because it signals that supply and demand are finally starting to balance out. They're finally starting to even out. And, you might be asking what's driving this shift. Well, it's pretty obvious in everyone's minds. It's the construction pipeline that's slowing. So new deliveries in 2025 are expected to drop by more than 50% compared to 2024. So this means that new units are coming online, particularly in overbuilt markets like Austin, San Antonio. There's a lot of hot markets that have been overbuilt out there over the last couple of years. And as a result, we're projecting a gradual decline in vacancy rates beginning in the second half of 2025. So that's a very good thing. It's been a long time coming. 2023, 2024, we've seen occupancy tick down because of all the supply. Finally, here in the middle of 2025, most markets and submarkets are going to see that uptick in occupancy, downtick in vacancy. But it's not the same story everywhere. So luxury properties, those 4 and 5 star assets that are really nice, they're seeing some elevated vacancies, especially in certain Sunbelt cities where oversupply has been a persistent issue. And conversely, demand for mid-tier and affordable units remains pretty robust, keeping the vacancy rates lower in those segments. So that means you're being your C-class properties where it's not as easy to build, units that have those types of rents. Now, the thing is, it does trickle down a bit. So when you have a high vacancy rate in these A-class properties, well, some of those individuals in your B-class properties might move up to the A-class properties, and the same goes for C to B. So the vacancy rates do trickle down as you see this massive amount of supply coming online. So for investors, what does this mean? This means that being selective about asset classes and location is just that much more important. Focus on markets where demand is outpacing supply, and that's, in markets where you have a ton of support with robust job growth. That is very, very critical. And then also make sure that you're factoring in the proper amount of vacancy in your underwriting. So just because a market is oversupplied doesn't mean that you shouldn't invest. It just means that you need to make sure that you're making the proper adjustments with your underwriting. So number 2, let's talk a little bit about rent growth. Now, rent growth has been stagnant for the past few years, 2023, 2024, moving into 2025, but there's a much brighter outlook as we move further along into 2025. So looking back, national rent growth hovered around 1% in 2024. And it's expected to accelerate to about 3 to 3.5% by the end of 2025. Now, that is a huge difference. If you take a look at your underwriting, let's say on a 150 unit deal, a 1% rent growth compared to a 3% rent growth is going to have a massive impact on your rents. But not only that, an even more massive impact on the actual value of the property, because it multiplies when you take that value or that NOI divided by the cap rate. So what's driving this? For one, again, the slowing construction pipeline means that there's less pressure on rents from new supply. So it's driving the rents down less because you have less supply coming on, or it's allowing you to increase your rents more. Second, demand is shifting towards these 1, 2, and 3-star properties, which have really consistently outperformed the luxury segment in rent growth when looking at the historical numbers. So let's take a look at the actual numbers. In 2024, 1 and 2-star properties saw rent growth of 1.9% compared to just 0.2% for 4 and 5-star properties. So that's what you typically see in the historical numbers, is these, blue collar B and C class properties are outperforming on the rent growth. Whereas the A-class properties, they have to deal with the supply that's coming online, and typically you're seeing a little bit less rent growth. Regional trends also matter. So Midwestern and Northeastern markets are leading the pack in rent growth right now due to more balanced supply levels. So there's less supply that was coming online, less properties being built, and that means that they have a nice stable rent growth. And that's typically what you see, especially in the Midwest. It's a very steady Eddy market, whereas you go to these hotter markets and it's more cyclical, more up and down. While some Sunbelt markets like, for instance, Austin and Denver, they've experienced some, negative rent growth over the last couple of years because of the new supply. So what does this mean for investors? This means that looking for opportunities in more stable, less saturated markets where supply pipelines are manageable might be a better option if you're looking for consistency. Or if you're looking in a saturated market, again, understanding the absorption rates, understanding the new supply coming online, and understanding how you should properly underwrite that when you're taking a look at the properties. So one suggestion I have is when you're taking a look at an asset, if you're seeing that there's a lot of supply coming online, ask the person that's in charge, that's going to be doing the asset management, what they've underwritten to account for this new supply that's coming online. And if you're not sure what supply is coming online, ask whoever you're investing with, or ask your property management team, if you're investing solely, if they can send you some reports on the current supply and the future supply that's coming online. This has a major, major impact on the near-term performance of your asset. So again, just make sure to ask those questions. All right, so let's talk a little bit about supply and demand. The supply-demand story is also pivotal for multifamily investors in 2025. So after a record 677,000 units were delivered in 2024, that's the highest since the 1980s, deliveries are expected to drop to just 346,000 units in 2025. So that's a very steep decline, almost 50%. So that's really falling off a cliff. And why does this matter to you and I? So it gives the market breathing room. That is huge. It gives the market breathing room. So many overbuilt markets will finally have a chance to stabilize and absorb all those units that are coming online or that have come online. And that allows demand to catch up to supply. So for example, in Houston, Atlanta, where supply has outpaced demand for years, this reduction in new inventory should help absorb existing units and put upward pressure on the rents. So kind of a repeating theme here. However, keep an eye out on local dynamics. Even with a single region, some submarkets will outperform others. So obviously, if you're closer to a downtown area, a lot of times you have more supply towards the core downtown area. So you might have a submarket there that underperforms compared to a submarket just 20 minutes out of town. So location matters. You've heard that a million times, when real estate investing. But when it comes to vacancy rates, rent growth, occupancy, all of this matters and is dependent on the location that the asset is located in. What investors should do. So I think one thing that investors should prioritize is investing in markets where there's really solid job growth and population growth. These type of, aspects of the deal or of the market are really going to help create that strong demand for multifamily housing. So keep that in mind. Make sure to do your due diligence there. Next thing that we're going to talk about is interest rates. So it's something that's on every single person's mind right now. A lot of fluctuations, very unstable over the last year or two. And interest rates have been a major factor in real estate, over the past few years. They always are, but over the last few years, it's even more so been because you've seen so much turbulence in the market. So we're going to try to keep this section quick and high level to avoid getting too far into the weeds. But if you have any questions, please make sure to reach out. So after a series of aggressive rate hikes, the Federal Reserve has reversed and is projecting modest rate cuts in 2025. So while progress on inflation has been slower than expected, the Fed's actions are proving to be effective. And as we saw with inflation coming in below projections in January, but that doesn't mean that inflation is fully curbed. There's still a lot of worries about potential inflation moving forward, especially with the new administration coming in and, putting out there that they might be putting into place tariffs. They might be deporting a significant amount, especially of the construction industry workforce, undocumented workers. I was actually just on another webinar today that one of our lenders was holding, and they were stating the fact that approximately 25% of the construction industry is undocumented workers. So what happens when workers like this potentially leave the country, whether they're forced out or whether they voluntarily leave, because the deportation is being pushed hard? Well, that puts upward pressure on the payroll, on the wages in that industry. So that would obviously inversely affect inflation, and it would be a negative for inflation. So that's something we're taking into consideration as we're progressing forward, just making sure that we're tuning in and that we're underwriting appropriately. And for us, putting fixed debt in place so that way we don't have to worry if interest rates go up for a little while because inflation potentially comes back. So let's dive back in. So the Federal Reserve has cut rates by 100 basis points with a 50 basis point cut in September. And then they followed up with 25 basis point cuts in November and December. So that was in 2024. Treasuries, on the other hand, which you would typically expect those to come down, your 5, your 7, your 10-year Treasury, which impacts the interest rates that Fannie and Freddie are charging on these multifamily deals because they're tied directly to the Treasuries. They've run by over 100 basis points. So you saw the Fed cut the federal funds rate by 100 basis points. And then you've seen Treasuries run by about 100 basis points in the opposite direction. So interest rates have actually gone up. And in the past couple of weeks, we've seen Treasury rates creep down by about 20 basis points. And it's not out of the norm right now to see Treasuries go up and down 10 basis points, which is typically a big fluctuation. So a lot of instability when it comes to interest rates, and a lot of that hinges on what people think inflation is going to do going forward. Because if inflation comes ramping back up, then people are worried that the Fed is going to increase rates and not cut rates. So what do we think? We anticipate that Treasuries will continue to follow suit in the federal funds rate cuts, although it's going to take longer than anticipated. A lot of people were thinking that rates were going to instantaneously drop when the federal funds rate was cut. That hasn't been the case. What we're doing now is we're preparing for rates to be at the current level for an extended period of time, as no one truly knows what's going to happen to interest rates moving forward and what's going to happen with inflation, as well as the current administration, what they're going to do on the tax side of things and the economy side of things. So again, a lot hinges on what inflation does, and we all know that inflation hinges on a lot of different levers. The market has had a lot of knee-jerk reactions due to all of the economy, job and inflation reports, which have not boded well for interest rates. It's hard to get a grasp on what is coming, as most of the reports coming out are very flawed or skewed in our opinion. So I don't know if you all have done a lot of research on the economy reports, the job reports, the core inflation, CPI reports, but they are very, very flawed. So you have core inflation, it strips out energy and food. Well, energy and food are massive pieces of what we're seeing for inflation. The jobs report counts part-time jobs similar to full-time jobs. Shelter, which is a huge portion of CPI reading, so the core, inflation reading, approximately 40% of the CPI is shelter. Well, housing prices typically lag behind about 3 months to a year behind. So what does that tell me? That tells me that the CPI rating is way, way out of date because housing prices have changed significantly in the last year. Rents, they're done through a survey in which landlords can say what they rent their home out for, regardless if they're renting or not. And this is extremely skewed. They call you up, they say, hey, what would you rent your house out for? Well, I'd rent it out for $5,000, even if the market value for that rent was $1,200. So this skews, that report. The other thing is the response rates have dropped significantly on these surveys. So the survey rate is about 10% right now when these agencies are calling out to potential landlords. And the survey, response rate was much higher back in the day. So that gives you an even more skewed number. With all this being said, it's hard to put faith in the reports that are coming out. However, the market still reacts as if they're all tried and true. So it's just something that you have to tune into. Now, the Federal Reserve's latest dot plot indicates that the federal funds rate is going to stabilize around 3.25% after another 125 basis points of cuts over the next 2 years. So again, it's going to stay pretty stable. Yes, they're projecting some cuts in the future, but it's really uncertain at this point in time. So again, what we're doing is we're putting fixed rate debt in place on assets that we're purchasing. So that way we have a 7+ year runway in case interest rates go up. Even if they go down, we're in a good situation where we've underwritten the proper debt and we know what our expense is going to be. All right, so we've beat the interest rate topic to death. Let's talk a little bit about cap rates. Over the past couple of years, we saw cap rates follow interest rates. They've increased by about 150 basis points over the past 3 years, which has impacted the value of multifamily and other commercial real estate significantly. This is materialized into a price reduction of about 20 to 30% across multifamily assets. And it depends on the asset class, it depends on the location, but overall, pricing is down by about 20 to 30%. So that is a huge drop in values over a short period of time because we've seen such a rampant and quick interest rate increase because of what the Fed did to curb inflation. Now, in 2024, cap rates for high quality assets, stabilized assets, were in the mid 5% range, while 3-star properties saw rates climb closer to about 6% cap rates. Looking ahead, we expect cap rates to remain relatively stable in 2025 as interest rates, likely to begin to stabilize and ease a little bit. And market fundamentals improve, again, going back to the rent growth, going back to vacancy rates, going back to the expenses stabilizing a bit where they were really ramping up significantly in 2022 and 2023. Currently, we're underwriting modest cap rate compression over the next 5 years. So we typically outline a 5-year projected hold. Over that 5 years, we believe cap rates will come down, 50, 75 basis points. And we're taking a look at industry reports. We're taking a look at primary data, what properties are selling for right now, because sometimes those industry reports are a little bit out of date, as they're looking back on historical information. So we're getting multiple different data points to make sure that we're making the most accurate projection for those reversion cap rates in the future. So let's talk about a couple different markets. First, we're going to dive into Nashville. Very, very exciting multifamily market in the US, Nashville, Tennessee. I'm sure you've probably heard of Nashville as the music city, but in the real estate world, it's becoming a real growth hotspot. The combination of population expansion and a thriving job market is turning Nashville into a prime market for multifamily investments in 2025. We started investing in Nashville a few years back. Obviously, the market has seen a significant amount of supply come into the market, but that does not negate the fact that there are a significant amount of people moving to Nashville. It's a very, very popular submarket, for new workforce to move to. Very popular, very business friendly. So you have a lot of businesses moving there. It's also a medical, one of the medical hubs across the United States. It's got over 500 medical companies headquartered in that direct market. So a little bit more about Nashville. Population growth. Since 2010, Nashville's metro area has grown by more than 27%. That is a huge amount of growth in just 15 years. That's actually the 12th highest population gain in the entire country. Today, the metro population has crossed the 2 million mark, and this momentum shows no sign of slowing down from what we're seeing. More people are moving to Nashville. Demand for housing is skyrocketing. Now you pair that population boom with job growth, and you can see why the city is a multifamily powerhouse. So major corporations like Amazon, Oracle, Bridgestone Americas have set up shop there, creating thousands of jobs. Oracle, for instance, which you may have heard, is building a $1.35 billion campus along the east bank of the Cumberland River, which will add about 8,500 new jobs by 2031. So that's going to bring a significant amount of people to the area. And again, Nashville's healthcare and tech sectors are also thriving. We always focus on markets with diverse job markets. We've learned that through experience. Looking back about 5 years ago, we invested in one project that did not have a diverse job market. It was in an oil country, and it was impacted so significantly when COVID hit because oil went negative. And we learned that lesson the hard way. So, my advice from me to you is focus on areas and markets that have very, very diverse job markets. So looking at the supply and the demand in Nashville in 2024, Nashville again saw record demand with over 10,900 units absorbed. And although that's massive, the market was also hit with an unprecedented supply wave with over 13,000 units delivered. So this supply has pushed vacancy rates to 11.7%, which is higher than the national average. But it's really important to note that you need to actually take a look at the actual granular data here. So the stabilized properties, B and C class properties, even A if they're stabilized, are sitting at about 8% vacancy rate. So this tells us that demand for existing non-lease up properties is still strong. Now those A class properties that are just brought online, that's where you're seeing a significant amount of vacancy. And that'll obviously start to tear down, once this construction really slows down in 2025. So looking ahead, only 7,000 units are expected to be delivered in 2025. So that's a dramatic drop from 2024. And this should help rebalance the market. For investors, this is good news, especially in submarkets where demand is still growing. So where should investors focus? In Nashville, downtown Nashville and southeast Nashville are both prime spots to watch. These two submarkets account for nearly 40% of the metro's inventory and continue to see some really strong absorption. Downtown Nashville in particularly has over 7,000 units under construction, which will expand its inventory by 23%. So you do have to be careful, especially in those downtown areas, because you still have quite a bit of supply coming online over the next year. At the same time, it's worth being cautious, especially in luxury properties. Those tend to have higher vacancy rates right now. For us, focusing on the 1, 2, and 3-star properties in submarkets with steady population and job growth, that's a safer bet for us. Now, that doesn't mean that we're not going to take a look at A-class properties in the downtown market, but our underwriting needs to be very, very conservative in those circumstances to account for the supply that's still being absorbed and the supply that's coming online. So that's it for Nashville. Real quick, before we wrap up, let's take a closer look at Dallas-Fort Worth. It's another one of our favorite markets across the United States, as well as many, many other multifamily investors. It's one of the fastest growing markets for multifamily investing. Population and job growth. So DFW continues to lead the nation in both population and job growth. Over the past year, the metro area added 64,500 jobs as of November 2024, bringing the total to over 450,000 new positions since 2020, which is a national high. So industries like tech, healthcare, logistics, financial services, they're all driving this growth alongside ongoing corporate relocations and expansions. So this economic momentum has also fueled a population increase of 153,000 residents in 2023. So let's get into the details. So vacancy and absorption. In 2024, net absorption hit 31,000 units in the DFW market. So it reflects a really robust demand center. However, develops delivered 40,000 units. So very similar when you take a look at the amount of units delivered and the amount of units absorbed compared to Nashville. Very hot market. And this pushed the overall vacancy rate to 11.2%, which is the highest in 2 decades. So again, too much supply, so the vacancy went up. That said, stabilized vacancy rates. So again, stabilized properties, B and C class, possibly some A class that are already stabilized. Vacancy rates are setting at a much healthier amount at about 8.7%. Deliveries projected to drop by 50% in 2025. And the market is expected to stabilize, creating some really good opportunities for stronger rent growth and occupancy. Now, talking about rent growth, rents have definitely softened over the past year, with overall asking rents declining by 1.4% in the DFW market. High-end properties saw the sharpest decline, while mid-tier properties also faced downward pressure for the first time since the great financial crisis, but not quite as much as those higher up properties. However, with construction slowing down significantly, rent growth is expected to stabilize and recover by the end of 2025. So the first half of 2025, we see rent growth being pretty slow. As you move into the second half of 2025, it'll start to ramp up. And then what we're seeing across the country, as far as industry reports and experts, 2026 is when we should really see some nice rent growth. around that 2 to 3.5%, 4% range, which is a fantastic number to be within. So again, work on getting through 2025, or at least the first half of 2025, and we should see some really good things once peak leasing season and summer hits in 2025. So opportunities in DFW. So the good news for investors is that the construction pipeline is finally tapering off. Again, 36,000 units currently under construction, down significantly from prior peaks. The market is positioned for a healthier balance of supply and demand. Some markets continue to outperform, and we're focusing on high demand neighborhoods where occupancy levels exceed 95% across the competitors. So we actually go out to these properties, we physically shop them as a prospective tenant, and then we ask the on-site staff what the occupancy is at. Typically, they're able to share that. You're also able to gather that information online. One thing I love to do is I go to apartments.com, pull up the competitors, and I'll take a look at the actual number of units available on apartments.com. And then lower down on apartments.com, you can always see the total number of units at that apartment complex. And you can divide that in to that number to figure out what their vacancy rate is. Usually you want to add a little bit because there might be some non-rent ready units that aren't reflected on apartments.com, but that's a great way to figure out where the current occupancy is at. So why Dallas Fort Worth? I think you obviously get it after we've walked through this podcast, but even with the current supply challenges, DFW remains one of the most attractive markets for multifamily investing. The combination of sustained job creation, the population growth, the slowdown in new construction, it all sets the stage for a recovery in rents and occupancy. And the fundamentals in Dallas give us a lot of confidence in continuing to invest in that specific market. So that's a wrap up for our 2025 multifamily market outlook. If you found this episode valuable, please make sure to leave a rating and review. It helps us out substantially. Thanks again for tuning in to Keeping It Real Estate. Don't forget to subscribe, share this episode with a friend, and leave us a review. Until next time, happy investing.